Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Bank of America, Murray Hill Properties, SJP Properties, Greenberg Traurig LLP. Additional funding is provided by grants from Antares Investment Partners, ARBOR Realty Trust, Athena Group, BRT Realty Trust, Burden LLP, C.B. Richard Ellis, City Habitats, City Investment Fund, CUSHMAN and Wakefield, Eastern Consolidated, Essex Capital Partners, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, Jackson Development Group, Meridian Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, PALIN Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Stonehenge Partners, Studley, SUTPHIN Properties, the WITKOFF Organization, Extreme Construction and Deconstruction.
Hello, my name is Michael Stoller, host of the Stoller Report, Real Estate Trends in the Tri-State Region. We're in, I consider it a recession. Many people look that we're in a tough time, but you know, is there any money out there for real estate? Is there money for commercial real estate? You know, you don't know. People ask me, people call me, they want to know what's happening. So as opposed to me, who has my own opinion, I've brought together today three individuals who are still lending for commercial real estate and will give us their thoughts on, is there money for commercial real estate? My guests today include Laura Tropp, Managing Director, Commercial Real Estate of the Private Wealth Group at Deutsche Bank, Peter Darcy, Head of Structured Real Estate Finance for M&T Bank. If I screwed it up, it's not my first nor the last. And last but not least, Head for the United States for Real Estate, John Gunther-Mohr from the Bank of Scotland.
Indeed.
So, since I know you two much more than I know Laura, there's money. You did $1 billion at the end of December, right? Well,
Absolutely.
Fourth quarter.
By fourth quarter, yeah.
And you, Mr. Gunther-Mohr?
Across the states, we did about $2 billion last year in new originations. About $1.2 billion of that was in the New York metro area.
And Laura, you moved over from Citigroup to Deutsche Bank since September. But how much do you think you may have originated?
We just started the business, so in the last, I guess, quarter, we've probably booked, about $150 million.
So my question is, how do these banks, your superiors, your credit teams, how do they look at the world we're in today in this real estate? I mean, the stock market has really been down a little bit. People say it's better, I think there was something from Pequot Capital, go liquidate your stocks, put the cash in the barrel, and just roll it. I mean, how do you look at this? How do you perceive real estate in this time?
I think for us, it's going back to fundamentals, and we are really a balance sheet lender. And so it's looking at the fundamentals of the real estate, and fundamentally, I think in many markets, they're still quite good. Certainly there are clouds on the horizon, and you have to be cautious, but we are lending, and we're looking at the individual deals and the sponsorship very closely. We are in a private bank, and so we are relationship driven, and so a big part of the transaction to us is who the sponsorship is and the overall relationship with that client.
Peter?
We're very cognizant that capital is precious. Prior to, I think, this credit crunch really that we're in, you could argue whether we're in a recession or we're headed towards a recession, but we realize that the market has, the CMBS market is not there at all, and we realize.
For my audience, I don't want to use like Fox Business. CMBS was the Wall Street boys and girls who played on this collateralized mortgage group.
Exactly, and the volume of business that they had taken from the players that were carrying the real estate lending market has been tremendous, and with their volume in 2008, depending on who you ask, projected to be down 50 to 60%. We couldn't all make that volume up even if we were as active as we possibly could, so we're trying to reserve our capital for relationships as well, for the clients that stuck with us when they had lower cost alternatives, and choose our deals wisely.
And the Robert Burns Society,
This has been an incredible opportunity for the bank, who's been in the States for 30 years, but just in a slowly building the business and really getting more active in real estate over the last 2 or 3 years. So for us, this is just fortunate timing for us who are trying to build a larger business here in the States, have a big balance sheet, are a portfolio lender, and all of a sudden this disruption comes along, which offers us opportunities which we frankly would not have seen. It would have taken a lot longer to achieve than we're seeing in this marketplace. But it's just been a crisis that cuts across all these markets, and it's more fear than liquidity. I mean, people say it's a liquidity crunch, but there is money. It's all run into treasuries and just sitting there waiting for stuff to settle down. And so it's really the issue of when to, across all real estate plus all these other sectors, that people feel like they understand the risk. And I think real estate, at least from a lending point of view, will come back relatively quickly, because the deals that we do, commercial deals, you can figure out the underwriting, you can figure out the cash flow, you can see the asset, you can feel and touch it in a way that you can't when you have these strips of paper with all these cash flows coming in and out, and are highly structured and therefore more difficult and more subject to risk. So I feel like this market in real estate will stabilize perhaps more quickly than the others. How quickly? That's still a hard bet or hard to call to make.
But we're talking about tangibles and real estate. And prior to the show, I asked Laura about the project. Laura really lends a true relationship. So do you. But I mean, even to the higher degree of relationship, it gets a one-on-one who may be customers in the private wealth management, who, as we say, personally guarantee every loan. And in your case, some of them there's a guarantee, and in your case it's limited. Same
as some it's guarantees.
But Laura, it's 100% of a guarantee. So you're looking at the real estate, and you're also looking at the guarantor.
Correct.
Now, what John said, with regard to fundamentals, here's my question, and I know that both. I don't think Laura has had that, because you won't do a new construction job or you won't do a land loan. How do you look at the fundamentals today in a difficult time that there's going to be the discontinuation of the 421A tax abatements, which helped a lot of condominiums being sold? How do you, and then there is this fear, okay, and it's a perceived fear. Mortgage rates, residential mortgage rates are down, but the spreads are going up. You can't get 5% down. There's no income verification. How do you go into, the other boroughs? Okay, Manhattan, as we said prior to the show, is centric. How do you go into Long Island City? How do you go to downtown Brooklyn? How do you go to Jersey City or Hoboken in this market when there is fear out there?
For us, we're actually looking at a big project in downtown Brooklyn, a high-rise condo, and it really is. We certainly have concerns about the marketplace. We believe in the location long term, which is important, and we believe in and have a very strong sponsor, and there is recourse that helps support that deal. So it really is that combination of things, and there will be. I'm sure, Peter, you feel the same way. There are a lot fewer opportunities that make sense to a balance sheet lender in terms of development deals. But there are a lot fewer lenders who are chasing them and looking at them. So you still see some really compelling opportunities that are really interesting and well located with good sponsors and all the right things that now have a shorter list of people who are trying to do them. And it's for us, it's a good, it's a wonderful opportunity.
I think it's important to draw the distinction for your viewers. The credit crunch that we're talking about was financing up to 90%, sometimes 85% on senior positions, and very frequently taking what we might have perceived as an equity risk for a piece of their senior loan. And at M&T and other banks, balance sheet lenders, we're not just making a bet on the next 90 days in the real estate market. We're handling and holding this paper potentially for a different cycle. So we're not going in, we're structuring things very differently than they might have in the past, and we're aiming to be consistent and to be there for our clients. We've also gotten more conservative, I think, as the market has gotten dicier or future projections cause you to have little consternation, but deals that might have gone off with 10 or 15% equity might require as much, with a CMBS product, might require as much as 40% equity from a balance sheet lender. So we're able to drive deals with quality sponsors today because of the void in competition that are structured with a much lower risk profile than deals might have been in the past, that give us a little bit of downside sensitivity as opposed to relying on a continued upward trend that isn't sustainable forever.
With layoffs and with losses from banks, Wall Street houses, there may not be that need for that much office space, new development, or certain tenants who were thinking of going to expand might not expand that quick. Well, what's the perception? And I know you said you did something in Greenwich a couple of months ago, and I know you've done over the country, all of you. Well, what's your perception of the office market today with regard to the tri-state region? I don't national. No. It's a different thing. Certain places nationally, Orange County, you don't want to talk about. But what about the tri-state region? I mean, the Greenwich market, which was a hedge fund haven. I mean, when you look at, even though it's one of your borrowers, would you really look to lend to somebody? And they said, I'm buying this building or I own this building and I really want this type of money in Greenwich, when 90% of the rents were from hedge funds, and some of these hedge funds may not be around.
I think you have to underwrite. I mean, in this case, it was retail, and then there was a little bit of office. But what we always tend to look at when we underwrite is not just where the market is, but if we're doing a 10-year loan, we're looking at what we think the sustainable market rents are as well. And we're really underwriting to those types of standards, which tend to be, certainly much more conservative than the old securitized lenders and what was going on 6 or 9 months ago in the market. I think all of us as balance sheet lenders now, the market has sort of come back to us, because what was getting done in the conduit market was very, very aggressive. And when you start to look at it and drill down into what the actual structures were, a lot of them didn't make sense. We had a tough time competing with that because we just simply weren't willing to underwrite to some of those aggressive standards. So I think, we continue to have the same discipline today that we had 6-9 months ago, which I think always tends to be a little bit more conservative.
But I'm also trying to, I know you live in New Jersey, I also believe you live in New Jersey.
Westchester.
Westchester. Yeah. And you're in the city.
Westchester,
you're in Westchester. And it's very interesting because these are different office markets than we're really talking about in Manhattan. And I think, and my subject is their money. In New Jersey and in Westchester, office rents have been the same 10 years ago or 20 years ago. Yeah. White Plains, a building in White Plains, unless it was right next to the train station, or if it was just in Westchester, in certain parts of Westchester, it's $25 or $28. They really haven't increased. Yeah. New Jersey, Bergen County, where you are, they haven't. I mean, so...
Not in Jersey City, and Newport would be an exception to that.
That's correct. Those are, but that's... The Gold Coast of Jersey City
of this market.
Is an extension of this market. And even in the Gold Coast over there, office rents for a brand new building where Deutsche Bank has space, or where the accounting firms or other places, office rent is $40 a foot.
It's interesting. I mean, it's definitely a challenging market in the office market. That being said, though, some of those markets have so little new supply being delivered to them that the new product is doing really quite well. We're actually doing on a direct basis, 2 office buildings that are not in Manhattan. One is in Englewood Cliffs on the sort of Miracle Mile, right next to CNBC headquarters. And is it a
CNBC tenant?
It wasn't when it was. We started as a spec building. It's a small building, so we're like, it's in the market. It's drum tight. You can't deliver any new supply there, and it is leased up very quickly. And CNBC is one of the tenants, but was not initially. We're also doing a project in the Bronx, which when you say you try to get a market data report on what's the office market in the Bronx, there is no such report because there is no Class A office in the Bronx, literally. So we have one on the Hutch.
Are you telling me there's no Class A in the Yankee
I'm
Stadium?
exaggerating, but
almost
there is.
I mean, there hasn't been a new
But
office
if you go to the
building
Cushman
with the
website or you ask Cushman, send me your office leasing report for the Bronx. I want to see that. And they go, well,
no, they will
we don't
say
have
there's
that.
the Hutchinson Parkway. They'll say
Yeah,
the
that's
Simone
the building we
property
got.
over there.
We got the Hutch Metro project. So that's
But
that's a very unusual sort of, and that's where you see you can maybe get something done. But taking an older building in a market where the rents have been soft and going down, that is a real challenge, and that's something we don't need to do that deal, given the size of our operation. So that may be a tougher deal to find money for.
You mentioned Greenwich. I mean, Greenwich is an example of a market, a sub-market outside of New York where there's huge barriers of entry to develop anything. So even with the alternative investment space and with a lot of those tenants being people, guests maybe in turmoil, that's still a very strong market. If you take something like Stamford, Stamford has, it's a very large suburb. It's not as strong potentially as something you say like Greenwich. And
at least you got two big bank anchors in there, that the UBS, RBS. But yeah, the rest of it is.
There's a lot of space there, and where those numbers will migrate. But for the right sponsor, with a deal can be structured for the right sponsors in a down market. And we're doing deals for top tier sponsors that we have relationships with, that we're very comfortable with, in markets that have some speculative component to them, that might not necessarily be in Manhattan, but it's done very selectively, and it might include some recourse component from very high net worth clients that might fit in Laura's business.
Prior to the show, we said that even as close to a couple of months ago, you might take a loan on, and you would do the loan and you'd hold it in your house and you'd try to sell off a piece. Today, the world has changed. What's happened? You don't really want to do a loan unless you know you have a partner. I mean, as I always tell in my classes and my show, basically the syndication market, the CMBS or collateralized mortgage market they were bookmakers. They took the loan and they found the brokers, the pieces who would take it. And if they didn't, if the apple fell at the end, that's what happened at the deal. Now, you guys have always taken risk. You take your own risk. But from what I heard before and what I see with you even in this Vail deal, you want to know that you have somebody committed to take that deal immediately. What's happened? Is it the fear of the market, or is it the changing underwrite? I mean, you said before equity is more, loan to values are more. What's going on even with that?
Pricing has changed so quickly that then that's what obviously the CMBS guys experienced, is they underwrote at one level, and a week later or 2 weeks later the pricing changed completely, and their loans were now, they'd have to in effect sell them at a discount to get them off their books. And so that has permeated, that loss experience has definitely permeated through the management of the major banks across the globe. And so they are not interested in losing money in that particular way right now. So the sense is definitely do underwrite, and we'll look at we'll underwrite what we can underwrite, and or maybe our position is a little, we're a big bank, so 75, 100 million is a deal size that we can underwrite, and we may just hold the thing. But if it gets bigger than that, then we're saying, well, we need to be in a group because we don't want to take that sell down risk. There might be a couple of unique situations where we're willing to do that, but in general, yeah, it's time for clubs to come together and do these deals. And
what about you? I mean, because you're definitely unique, but I mean, if some single borrower came to you, a very strong net worth, would you try to sell off a piece, or would you keep the whole thing?
Generally speaking, we keep the whole thing. We don't have to sell down. That's our mandate. We have a generous hold position on any single transaction. Having said that, there are some deals we do in a club situation, and so up front we're going in with the bank group, and we're not taking the whole thing.
I mean, if you look at what happened in the CMBS market, whenever people wonder when is it going to open back up again, everybody seems to consistently say one thing, that they have to clear the overhang first. And once that happens, possibly they will consider making new loans, as long as investors are hungry for that paper at a reasonable rate. But banks don't want to be in that position. We didn't get into that position. And at this point, we're underwriting deals. If we're doing a full underwriting, we are doing so because we're, at the end of the day, willing to hold the whole thing. And if not, and we're possibly doing that for the right people and the right assets. And if we're not, we're going to put in flex and sell down language, or do our best to align a bank up front and take that risk off the table. Because, as John mentioned, the pricing has been so volatile that you could make a loan in an environment that you think you've seen most of the move, and it could move from there further, and it's just better if you can manage that risk.
Clearly see that the big deals are the ones, 100 million, 200 million plus are the ones that are really struggling to find a home now. And I think that's going to take a longer time for the CMBS market to come back to handle those, because they had to slice those into pieces and drop each piece into a different deal to make that work, to manage the exposure limits, and they got good at doing that. But I think the market's going to move away from that complexity of having different pieces all distributed in different things. It gets too complicated. It's back to CMBS. I think will be lots of small loans, nicely diversified, simple term loans, where you have a granular portfolio. And so I'm what's going to happen if somebody wants to buy a building in Manhattan and wants to pay $500 million for the thing? And there are some buildings in Manhattan that are trying to trade now, and that's certainly part of the struggle, is how do you finance that thing? It's a challenge. So it will be good for the few lenders that can still do some piece of it.
Yes, Peter.
I was going to say, if you're a stockholder in a corporation that owns that has a real estate program, you really like the fact, you look, we have a $5 billion portfolio roughly of commercial mortgages in our New York City business. When our average loan to value in that whole book is slightly over 50%. We have tremendous granularity to it. When you start making very large bets on large loans that you're not selling down, it changes the risk profile of that overall portfolio. And we want to grow our business and migrate it and continue doing those deals and have successful syndications. But there's no need to take on additional risk unless you're really getting paid for it and you're very sure you can manage it.
Now, speaking of risk, there are banks, Chorus in Chicago and some other banks, and I don't want to, since John and I are the older ones in this group, we're not considering you, Laura, you're too young. He's a baby. But when these banks went out of business a number of years ago, and there could be this, because it's not only their exposure in New York. Some of these banks, they lent in Florida, and people are dropping their contracts. They're walking away from these deals, and there are all these problems. What effect do you see? And it's a double-fold question. In many aspects, I remember real estate was .com business. Similar concept. Everybody wanted to own a .com stock. I'm going to make all that money. Then everybody was trying to I want to buy an apartment. And, even in your development, which is a great project, the Aries in Queens or the others, I'll buy that property and I'm going to flip it to someone. And I always tell the story of the podiatrist who calls me up. I'm going to buy this apartment at this point. I said, what are you going to do if you can't flip it? He says, don't worry, I'll flip it. I said, but what if you can't? And my question today is, there are still apartments being condominiums being acquired. And, what happens if these developers get these contracts and people say, hey, I don't want to close on the deal? What effect is this going? I don't want to be the guy with the handful of the prophet of doom. But what happens if these people don't close, and they don't get their bonuses?
The laboratory is in operation in Miami right now to evaluate that. It's a messy, complex process of some of the units do close, some of them don't close. How much does the loan get paid down? What is relative? How much inventory is left? I mean, it's definitely a stretch.
This was the problem here. People were saying, people would go, once there was an open house, they'd go there and wait online, and I gotta buy it, and then certain of these things aren't selling like that. I mean, where you are in New Jersey, somebody came to me about a condo deal, which is no longer a condo deal. Now it's going to be a rental deal. And not everything makes sense as a rental deal because people have to pay rent. And how much there was a study of the New Yorkers or people in this area pay more than 50% of their income for their rent in the market. So what happens in this? I mean,
that's where one of the big risk factors in. Obviously, New York is Manhattan. We talked about is attracts foreign capital.
Leave
Manhattan aside.
We
the
have
normal,
guys,
actual real people who have to work and pay rent.
Right. And a good example is there. You talk about the Bronx. There's Riverdale, which is a beautiful community in the Bronx. They can't sell the condominiums.
Terrible condominiums.
Everybody thought that Riverdale, which is this enclave, would have a great opportunity. They're all failures. I haven't heard of one.
We've stayed away from the market in Riverdale, and there's a tremendous amount of product coming online. And if you looked at the break-evens and you looked at the rentals on the rental assumptions on paper, it all looked pretty good, and it seemed to play into the story of the larger strength of the market. But there are some pockets that seize up faster than others, and Riverdale's one of them.
I mean, a mutual friend of John and I has a development in Riverdale through a partner, and I said, so you'll rent it? He said, I can't rent it for enough. And I said, why can't? He said, I can't get more than $30 a square foot. I said, but you can go to Washington Heights and you get more. He says, people don't want to go to Riverdale and pay that price. It's a question.
It's definitely an issue of trying to deliver the affordable product. And now this obviously the governor's focused on it, everybody's focused on it, and it's still an issue that you don't have an answer other than you build a lot of product, banks lose a lot of money, it's now recycled at a lower price point that people could afford. That may happen in some of these markets, like these condos. If they don't work, then they may get recycled as rentals after the new owner comes in and buys it for 50 cents on the dollar, and then he can rent it for $30 a foot and make rent.
Because they're viable today, and at least I know we're not just New York focus, but there's a viable backup and a rental strategy as an exit strategy on sponsor-owned units today. There's about a 2% vacancy rate with the residential units in New York City. So most of these, from the senior lender standpoint, are underwritten to work in a fallback rental scenario. Maybe there's partial recourse, and likely the developer will lose out, and the equity tranche or mezzanine tranche, if there is one, will be the first to go. And the question will be, is there enough left over for the senior lenders? That break point, based on the advance rates of that at least we've been lending at, would probably allow for roughly a 50% decline in values. Is that something that's going to happen? It's possible. Okay. You never know.
So in summation, people like you who are balance sheet lenders will continue. You're cautious optimistic. Okay, it's not cautious pessimism. And this too, it's not like the biblical story. The very good years we've had, about 14. It'll take a little time, but the transactions will change. I'd like to thank Laura Tropp, Peter Darcy, and John Gunther-Mohr for being here. Next week, we're going to talk about the office market with these masters of the universe who know what's happening in the office market. See you next week. Thank you.
Major funding for these programs is provided by grants from HSH Nordbank and First American Title Insurance Company of New York, Perfect Building Maintenance, Allied Partners, Bank of America, Murray Hill Properties, SJP Properties, Greenberg Traurig LLP. Additional funding is provided by grants from Antares Investment Partners, ARBOR Realty Trust, Athena Group, BRT Realty Trust, Burden LLP, C.B. Richard Ellis, City Habitats, City Investment Fund, Cushman and Wakefield, Eastern Consolidated, Essex Capital Partners, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, Jackson Development Group, Meridian Capital Group, McSam Hotel Group, Newmark Knight Frank, Moynihan Organization, Muss Development, PALIN Enterprises, Rosenthal and Rosenthal, Signature Bank, Sidney Fettner Associates, Stonehenge Partners, Studley, SUTPHIN Properties, the WITKOFF Organization, Extreme Construction and Deconstruction.